Yo, what's going on, guys? Welcome to another video. Today's lesson is going to be on introduction to order blocks, and yeah, let's get straight into this. So we all know that the main thing that differentiates us from the retail trader and what makes our trading style slash strategy special is that we trade with order blocks or institutional candles. These are both the same thing, there's different names. So first things first, let's get into the introduction of what an order block really is. So an order block is basically, order blocks are a specific candlestick pattern that help you identify where the banks are entering and getting out of the market. So we know that with the support and resistance, it's almost impossible to find out where the banks are entering. But with order blocks, this helps us identify and understand where the banks are entering, where the banks are not entering, where the banks are getting out. And the way we can identify this is by looking for the institutional candlestick pattern, which I will show you guys in a moment. And yeah. And then yeah, so then we have order blocks are mostly found on untested levels of where price had major expansion moves up. Majority of the times the OB will be found in the start of the expansion. So if you guys did watch the institutional market cycle video, you might have a small idea of what I'm talking about, but I'll show you guys some real life examples just now. Not all order blocks are valid. We must create rules designed in our favor of which order blocks we use and which ones we don't. So that's pretty self-explanatory. Obviously, everything you do in this trading game, we need rules. If you don't have rules for something specific and you just take, it because it has the name order block, then obviously it won't work out. So you need to create rules designed in your specific favor and designed in your trading style. Order blocks come in all different sizes. Some order blocks have more volume than others, and some order blocks have less, which is pretty obvious. So let's go to the rules we created for order blocks. So an OB, for it to be valid, it must break structure in order to consider it as a valid OB. The OB must be followed by a strong momentumous push up or push down depending on the trend. We do not take OBs that go against the trend. OBs that are deeper in the expansion are stronger than OBs that are in the middle or at the end of an expansion. If there is an OB that swept liquidity, it is much more stronger, has more probability of playing out. So now let me actually show you what an OB looks like. So this is initially what an order block looks like. Let's say the market is pretty bearish, right? It's selling down, and then randomly we have this last major momentumous volume candle down before the major impulsive move up that actually broke structure towards the left, right? So it has to break structure. If it doesn't break structure, it's not valid. So right here we can see that the market was pretty bearish, and let's say theoretically the market was pretty bearish, and then it sells down. Now right up to here, when it did sell down, what we saw is that price created this last down candle before this major move up. Now there's two ways of understanding this. One way is just by ignoring what this actually means and just seeing it and understanding that this is where the banks are entering, and price revisits that same level to the open of the order block, and then from there continue up. Or you can get the more in-depth explanation, which I'll give right now. So initially what this is called is the banks selling to buy. So we can see that the overall trend was moving down, right? Overall structure was down. Now right over here, the banks sold. They added let's say this last down candle right here, they sold and added 1 million sell contracts, right? They added a 1 million lot position right over here, and right after they added that 1 million sell side lot position, they also bought at the same time for 2 trillion. So now they have a $2 trillion lot buy position running and a $1 trillion sell position running. So obviously you can't have a buy and a sell running, because eventually you're going to end up losing money, or you're just going to be in a break-even position. So what the banks end up doing is they push price up to make every single retail trader, even smart money trader and other traders, to assume that now price is bullish. And this is where FOMO comes in, where you start buying over here, and over here. Basically you're buying at the end and you're chasing the trade. If you've seen an expansion that already finished, or price is all the way up here, don't try to chase the trade. Most likely it will pull back. So price ends up pulling back. Why? Well, the reason it pulls back is because price has to mitigate their sell position. So they decide to they push price up to here, and they don't close their buys. They're holding their buys. But what they do is they stop trading, and then retailers come in and price goes down. So retailers come in and then price starts pulling back down. Now at this point, this is where the banks push price down and they mitigate, meaning they close their last sell position. You know how when price comes up to our stop loss and we move our stop loss to break even, we get tapped out? Same thing. The banks basically push price back down to the open of the last institutional down candle before the major move up, because this is where they last sold to buy. So what they're doing is they push price down to close their sell position at break even. And then at this point, they don't need to worry about sells because they have their buys running, and they add more buy positions in this area right here. Now, someone might say, okay, this looks like a clean institutional up candle before the move down. Now, technically, yes, but like I said, we have rules. And if you are going to follow your rules, you would know that institutional candles generally play the most sense when you're trading with the trend, and against the trend, it can get generally really, really risky. So that's initially what an institutional candle is. Now, for the easy example, what you could say is, okay, the banks decided to buy right over here, and they push price all the way back up. Now, for some reason, they have to bring price all the way back down to the original area of where price expanded, and they just come back to that last down candle, and then they continue going up. So that's a really easy understanding of what an institutional candle is. Now, I'll be showing you guys some live examples, but before I do that, let's actually implement what we've learned so far throughout the course, and let's use that let's use order blocks with that. So right over here, untested levels and implementing what we learned. So this is a bearish example, this is a bullish example. So overall structure is moving bullish, right? We have a low, we have a high. Let me actually label this down. So we have a L right here, which is a low, and then we're followed by a high right here. Now after that high, we're followed by a higher low, and then we're followed by a higher high, and then once again we're followed by a higher low, and then a higher high, and then once again. Now this isn't a higher low. Remember what I said, the reason this is not the true higher low is because it didn't make a higher high. So initially we're in a trading range. Now if you guys fully watch the institutional market cycle video, you would understand why price revisits this area right here. One, because there's liquidity resting here. So we have our expansion, and then we have manipulation where price is generating liquidity of the highs and the lows. Now because we are moving pretty bullish, price is obviously going to take out the money of the lows first and then take out the highs. Now in the rules section where I said if an OB takes out, if there is liquidity above or below an order block, that increases the probability of that order block playing out. Now right here we can see that price comes back into that original area where price fully expanded. It makes a deep retracement into the start of that expansion. Why does it do that? Well, because there is an institutional last down candle before the major move up, and in this case price has to come back to mitigate that last institutional down candle before the major move up, and this is where price creates its big move. Now one way of also looking at this is simply just highlight the expansion where price made big moves. In this case, this is one expansion, this is a second expansion. If price did not want to respect this area, then most likely price would respect the next untested level of expansion, which would be right over here. Now over here, this is theoretical obviously, but yeah. Now a bearish example would be like this. Price is moving up, we're creating a low, we created a high, and then we created a higher low, and then a higher high, and then a higher low, and then a higher high, and then automatically we end up breaking structure. The market goes down and breaks structure towards the left. Now from here, after we do break some structure, price manipulates. Now what does this manipulate identify? This manipulation identifies that there's money resting above and there's money resting below. And like I said before, if there is money resting above or below your point of interest or order block, then that increases the probability of your order block. Now let me tell you why. If retail traders are selling at this level right here, a ton of retail traders are selling, their stop loss is going right over here. Now evidently this is also where the market created its deep expansion that broke a ton of structure. Let me make this blue, and boom. So this is also where price created that deep expansion that price broke structure towards the left. So this does identify that there's a lot of momentum inside of this area of interest, or rather this expansion cycle. And if price were to come back into that area, there is an order block right here. There's a last down candle before the major move. In this case, this is supposed to be bullish. I'll show you guys the bullish example just now, but this last up candle before the major move down, and price comes back into that area to mitigate it. Now if that's confusing, look at this. While institutional traders are waiting for price to come back to this order block to sell, what retailers are doing is they're selling over here, and they're putting liquidity inside of our institutional candle. And we all know how liquidity works. The market's gonna have to break above the liquidity, tap into the stop losses, and then go down. Our limit or entry limit is basically where all those stop losses lie or rest. So while all these people got stopped out with this move right here, institutional traders were actually getting involved in positions right over here, while retailers were getting stopped out. And that's generally, and then you can target obviously the next low of liquidity, and that's generally how order blocks work. Now obviously this is theoretical, so I will show you guys a real life example. Let's go to GPUSD right over here. So like I said, if the overall trend is moving up, you generally don't want to trade against the trend. If the trend is going up, ignore any sell side order blocks, ignore every single bearish order block you see. The reason I say this is simply because price action has specific ways of moving. Now if the probability is the market is creating higher highs, higher lows, then the probability is that if the market does see a really clean institutional candle, like for example right here, most likely price is going to end up breaking that high and make a new high, because that's what we're doing in an uptrend. Now right over here we have this area of manipulation. We have this expansion move up, and it did give us a continuation of structure towards the left. If we look right over here, we have this high, and then we follow it up with a new high, and this tells us that that's a continuation of structure. So we have that COS. Now this is also our expansion, right? We have two expansions, one being right here. This is our retracement, and then this is our second expansion. So right above our expansion, what we see is that we have this area of manipulation. Now above this area of manipulation, there are stop losses of the highs, and then we have stop losses of the lows. Equal lows. So we have stop losses of the lows. Now below that level, like I said, you want to be focusing on the start of that impulsive move up, that expansion, the start of it. Now in the start of it, you're gonna find an institutional candle. Sometimes you'll find it over here, sometimes you'll find it over here, and sometimes you'll find one over here. We're gonna get into all the differences of which ones you take. For example, right here we have two areas of interest. We have 1, 2, and 3. Someone might ask, okay, which one do I take? Now this is where it gets really simple. What I want everyone to do is go back into the chart at this time, find an area of interest or something, and measure your expansion. So for example, this is my expansion that broke the previous high, made a new high. I want to label my expansion with my Fibonacci from the high, from the low to the high. Now any institutional candle that's above the 60, above the 70, 78, or 88 is no longer valid. So this institutional candle that we're seeing, this last down candle before the move up, it's not valid anymore. This institutional candle is in the 70. It's basically inside of our blue zone. We have a blue zone of interest right here, 70, 78, and 88. These are our golden levels that we're focusing on. And evidently this is also inside of the expansion. So what our idea is that price would come back to revisit either this institutional candle or this institutional candle. Both of these have high probability. And like you guys know in the micro structure versus macro structure video, when price does come down to these levels, we obviously want to go down to the smaller time frame to identify and investigate what price does. But in this case, price comes back down, taps perfectly into our institutional candle, and the way we would mark it is by marking the open to the low, right? I don't think I showed you guys that. Let me go back up. Yeah, right here. So it says, how do we mark it? So generally the way you want to mark up, I don't know why that's like that. Alright, ignore that. But basically, once you identify your order block, the way you mark it up is by labeling the open of the last down candle and the close of the last down candle. In this case, this is our last down candle before the move up, and vice versa for a bearish example or a bullish example, last up candle before the move down. Once you identify it, just label it open to the close. My bad, let me just go back right here. So right over here, we label the open to the close. Now from here, our entry would be the open of the order block, and our stop loss would want to be below it could either be the close of the OB, which is really risky because most likely will get stopped out, or you could put it at the wick low. So if there's any wick low that you do see, for example this wick or this wick right here, you can put it below there. So that would be a 16 pip stop loss with a TP of about 183. And why are we targeting here? Well, let me show you why. Our targets are based off by where the money rests. Right over here, we can see that there's equal highs resting above over here that the market has to take out. And like I said, the market is like a magnet. Liquidity is like a magnet. It's going to use those levels of liquidity and reach those levels, and that's what ends up happening right here for a clean 11-to-1. So now right here, this order block is mitigated. It's no longer valid. Now look at this. As soon as we printed that last down candle before the move up, price revisited that same institutional candle to test it. And look, this is an untested level. One, it's untested. Two, retailers are not thinking about buying here. No, they're thinking about buying right over here at this area where there's equal lows. We can see that there's equal lows over here. There's a test, another test, another test. 3 tests of support. Price breaks below it to take out all that money, and their stop losses rest all around here. All their stop losses are all over the market, just chilling over there. So we know that price comes down, price taps us in when retailers are getting stopped out. So we're getting in when everyone is getting stopped out. Now right over here, we broke structure, whatever. Price creates a new expansion back up. Price creates this new expansion, and right now, like I said, whenever price creates a new expansion, what we're going to do is we want to focus on the beginning of that expansion. In this case, the beginning of that expansion is going to be right over here. This is where the expansion started. So I'm going to take my Fibonacci and I'm going to find out where the expansion began and where did it finish. So the expansion began right over here and it finished right over here because this is where the market started retracing. Now I'm going to be looking for institutional candles that are in the 70, 78 or the 88. If it's not in one of these blue zones, I'm not interested. And right here we can see that we have this last institutional down candle before the major move up. Now you see how clean that is. Price, we created that institutional last down candle before the major move up, and there's also liquidity forming right above our area of interest, meaning price is going to have to come back down into this level to stop everyone out, and we're getting in when they're getting stopped out. And look how perfectly price action comes to our institutional candle right over here, and then we target the next high obviously for about 4-to-1, which is not bad, but we'll get into refining entries later on. And you can see that price goes towards the next high because there's liquidity over here, and overall structure is bullish. We know that structure is higher, is bullish. We're making higher highs, higher lows, so it doesn't make sense to be taking a sell right now in an overall uptrend unless you are on the smaller time frame trying to catch a scalp from like here down to here, which is completely fine. So catch that buy from here to here, target where the money is. Now at this point, let's say you close your position and you see an institutional candle right here and an institutional candle right here. At this point, this is where you need patience, because you don't know if the market is going to retrace or manipulate over here and then go down. You don't even know if the market is just going to continue going up. It's all about patience. So let's see what the price ends up doing. So boom, let me go back in time right here. This is where patience come in. So we have our overall expansion, our first expansion right over here. This is where the market retraced. Second expansion right over here. Now technically you could say, okay, this is your expansion, this is your retracement. I took it from the higher picture. I took it from here to here because this is where the market created that big move, and then this was the first proper retracement and then the first continuation. So now we have two valid areas of interest. Let's take our fib from this high, or from this low to this high. Our areas of interest would be this institutional candle right here, because this is that last down candle before the major move up, and this institutional candle right over here. Now with this expansion, if I label it from this low up to this high, our area of interest would be this last down candle before the major move up. And if we go down to the 1 hour time frame or the 3 hour time frame, we can even see a proper one right here. Let's go to the 2 hours, see if there's any more. We have a 70 one right over here, but this one did not get respected. It did get rejected over here, but overall the market ended up tanking and not respecting it. But let's see what the market does if it respects this area. So right over here, what does price do? Well, let's go back to the 15-minute and let's understand liquidity. The market generated a ton of money just above our area of interest. We have a support test here, a support test here, support test here, and a support test here. Go back to the 4 hour time frame, and we can see that we have that institutional candle printed below where all the liquidity is, meaning the liquidity is above our area of interest. So we're getting entered while everyone else is getting stopped out. Entry is always on the open. Now for entries, you can do two things. You can either highlight your institutional candle, which would be right here, this low to this low, and you want to take your fib, go to the range fib, and measure the range of your institutional candle. Now entry could either be the 50%, meaning you set a limit at the 50% right over here, or you can enter right on the open. Now the 50% is really conservative. You tend to miss a lot of trade opportunities if you do take the 50, because sometimes price misses it by a few pips, just like it did over here. It missed it just by 3.5 pips. So that's why I usually always open with the open of the order block. But I hope you understand why I chose this institutional candle and not this, because this is the original move up. This is that entire push up expansion. This is the retracement. This is the expansion, right? Let's label that right now right here. Purple, and then boom, and then price re-expands right over here in blue. So now we have our institutional market cycle. Now we also do see that price action still left these two institutional candles. Oh, by the way, we would basically just target the next high, or you could target over here depending on if you're scalper. Either way, this was a nice 100 pip TP that did end up getting smacked, and then price made its way back down. Let's see what price ends up doing. Now as price did make its way back down, it ended up reacting off of an institutional candle over here. But because I said we have rules that we have to follow, we're not taking this. We're not worried about the institutional candle here. We're simply waiting and being patient. So right now there's no confirmation for any trades, but we'll look at this. What we are noticing is that there's liquidity now being generated of the highs. That means that price is going to make a run above the liquidity to do what? Well, to obviously clearly go higher. Now we don't have much proper confirmation for a buy yet, because we don't see any proper levels, because all price is doing is it's manipulating right now. It's not doing much. Now from here, let's go down to the daily time frame. And what we can see on the daily time frame is that we have this last institutional down candle before the major move up. You can also use the 8-hour time frame to get a better understanding. You know, you can refine it up to here. We'll get into refining on a different video. But generally what I'm trying to show you guys is that every single time frame has an OB. Now we generally want to stick to the higher time frames, because the lower time frames are definitely really deceiving. For example, if we check the 30 right now, we can see on the 30 that there's an institutional candle here, right over here. It's really ugly and annoying. If we stick to the higher time frame, it makes it a lot more easier to follow. And yeah, so price ended up, let's see what ends up happening. So right here, perfect example. So right here, price ends up reacting off of the daily institutional candle. Now we did not catch it, obviously. Price missed it by like a couple pips, because we did take it from the 4-hour. But so price reacted off of the daily institutional candle, and then price does its thing and goes up, right? But look at this. As it did go up, what did we do? We broke a ton of structure. We created this low, lower high, lower low, lower high, lower low, higher high. We broke structure towards the left. And like I said, if an institutional candle breaks structure, it's much more stronger and probable. So at this point, where's my expansion? Well, my expansion is right over here. Now, do I have two institutional candles I can focus on? Definitely. Let's go down to every single time frame and see which one we can use. Now, the 8-hour time frame is the best, in my opinion, to label your institutional candles. I like to use the 12-hour as well. It is really nice. But okay, so in this case, price did end up missing our institutional candle just by about 17 pips, and that's gonna happen a lot. That's something that you're gonna have to deal with a ton of the times. It'll happen every single time. Like, trust me, it's all about just having proper patience, but it will happen, and that's something that you're gonna have to get used to. But from here, you can see what price ended up doing, right? It ended up breaking past the new high. Let's just play this out, and now look at this. So let's delete everything and let's analyze what price action did. We broke past the previous high, which is right over here, and we created a new high. Now what we did is we created liquidity right below an area of interest right here and right here. We have basically equal highs and equal lows. Let me just change this really quick. Boom. liquidity top, and liquidity bottom. So we have liquidity resting below. Now inside of our liquidity, where that's resting below and above our areas of interest, what does this mean? Well, this means that price is manipulating right now, consolidating to go lower, to bring price lower. Now let's identify where our expansion is. First expansion, right over here. Second expansion, right over here. And let me tell you guys why this is my second expansion. Let's go down to the 4-hour time frame really quickly. Sorry about that. I had to quickly do something. But this is my first major expansion towards the upside, and then this is my second major expansion towards the upside. How do I know this? Well, look, price pushes up. We have that small retracement, and then we have that continuation. So what am I going to do at this point? Well, I'm going to investigate the beginning of my expansion. So let's go down to the 3-hour time frame, and let's look for institutional candles. And right over here, what do I find? We find this last institutional down candle before the major move up, and it gave us a continuation of structure right over here. COS top. So now we have an area of interest. We have an area of interest right over here because this is the start of that major move. Now there's liquidity inside of our level as well, because there's people that are taking buys at this level of support, and that means that, you know, liquidity rests here. Now there's also a high probability chance that price will make a run back down, all the way back down to here. And if we, you know, measure out from our fib background levels, what we can see is that we have institutional candles inside the 70, 78, and the 88. So one would be right over here. That's one institutional candle that we have, and the second one is right over here. So that's two possible points of interest that we have in order, if price were to come back down towards this current expansion. So generally what we would be waiting for now is for price to come back down, and if it did come back down into one of these levels, you could do two things. You could either set limits on both of these, and most likely one of them would play out, or you could do what I do, which is wait for confirmation. In the micro versus macro entries video I made, you guys would understand that I waited for microstructure to switch to bullish. So when price does make its little run back down into my area of interest, we're going to see some bear structure form. Once I drop down to the smaller time frame, I want to see something like this happen. I want to see a break of structure of the previous microstructure, and then a retracement to that overall area that broke structure, that expansion that was responsible for that break of structure. And then from there, we'd be looking for institutional candles to, you know, fill our entries to go higher. So that was basically an idea of how institutional candles work. I'll show you guys how some of the trades I did take on NZD/USD before, which is right over here. So let's go down to the 1-hour time frame and let's analyze this. So 1-hour time frame wise, NZD/USD, we saw that we had this bullish structure forming. We have a high, higher low, higher high. Now right over here, market consolidates and breaks structure. We broke structure towards the left right over here. Now this is also where the market expanded down. This is where the market had the biggest expansion down. There's so much momentum. So someone says, okay, so how do you take the trade? Well, it's really simple. Find that last institutional up candle before the move down. And in this case, it would be just like this. Now, in cases like these where the institutional candle, it has more wick than body, for example, right here, the institutional candle has a lot more wick than body. So what I would do is I would highlight the entirety of the candle from the wick to the wick. But if there's more body, for example, this one, I would take it from the body to the body. But because there's more wick than body, I would take from the wick to the wick. Now, I did end up refining it just up to here. And as you can see, price ended up coming perfectly into our order block or institutional candle, whatever you want to call it. And then price ended up selling off for about, TP did end up getting missed, but we did end up getting stopped out at break even, but we did take partials, right, just like I said in the risk management video. But that is a 20-to-1, and just by understanding the expansion and by institutional candles. And let me show you guys some more. GBP JPY, right? GBP JPY right over here. We have this bullish structure forming. We have a low, we have a high, higher low, higher high, higher low, higher high. Right over here, price ends up pushing down. We break structure, we broke a previous significant higher low. So in this case, what I'm saying is, okay, fine, we broke structure, that makes sense. At this point, all I need to see is price retrace back into that last institutional up candle that was responsible for all this expansion that was down. So what I did is I set my limit right over here, and price filled me in perfectly, filled me into the pip, and then I took the sell, I think somewhere down here. TP did get hit, and look how clean that was. We go down to the 45, we see this last institutional up candle before the move down, right? And that's generally how I caught this really nice trade entry on GJ, which was a clean 12-to-1 risk to reward ratio. Now let me show. Now I know I said that don't trade against the trend, but there are ways you can trade against the trend if you are looking for scalps the way I did for this one. Now we'll get into that in a different video, which would be a buy to sell, sell to buy hedging video. But for now, let's just stick to this. So right here, someone says, okay, wait, look, isn't this technically a last institutional up candle before the move down? Could I take a sell here? Yeah, you could definitely take the sell here. You take the sell, but look what ends up happening. Price ends up breaking past that level. Not even that, but let's go down to the 4-hour time frame and look at this. We see a last institutional up candle before the move down right here. There's a ton of momentum. The candles are big, everything. We broke structure, but look what ends up happening. Price breaks above it and continues going higher. And that's simply because price action had is been in an uptrend. It's creating higher highs, higher lows. Now let me go to GBP JPY and show you guys something right here. Oh, that's the same one, my bad. GBP JPY. Boom, let's delete all this. So GJ, how did I catch this buy? Well, overall structure is up. Like I said, macro structure is high. Right? We have a macro low, macro high, macro low, macro high, macro low, macro high, macro low, macro high. So we know that overall macro wise we're extremely bullish. Macro wise extremely bullish. And GJ at the time it was making deep pullbacks. For example, right here to here, it made a deep pullback, extreme deep pullback for about 406 pips. Now, if the market made a deep pullback for 406 pips, but it's still respecting macro structure, this does tell us that JJ is obviously going to make another deep pullback. It's not going to be making these small pullbacks. So let's highlight our expansion. First expansion, being right over here. Market comes back into what? Into this last institutional candle. Sorry, this last institutional candle on the 8-hour time frame. How do I know that? Well, look at this. Price perfectly comes back to the overall area where price first expanded, taps into that institutional candle, and then goes up. Now what happened here? Price created this last institutional candle right over here after it finished its retracement. So purple for retracement and then blue for expansion once again. We have our expansion. Now at this point, price created this last institutional down candle before the major move up, and we created a new high, giving us a continuation of structure. So I'm going to delete this now to make this a little cleaner. So obviously, because price last time it retraced, it made a 400 pip retracement. We're expecting the same exact thing this time. We're expecting a 400 pip retracement. Look how both of them align up with each other. And this institutional candle right here, this last down candle before the major move up, it's unmitigated one, it's untested, and look at the momentum. So at this point, we'd simply wait for price to come into our area of interest. And what happens? Before price comes, it creates liquidity. Right, liquidity bottom. We have equal lows resting over here, meaning price is going to have to come down into here to hit all those stops. And look what ends up happening. Price ends up going down to take out all those stops. The candle is closed below this time, taps into our institutional candle perfectly. And what do we do? Well, because macro time frame was extremely bullish, we know that this is the deepest price could go. If the price disrespects his macro high or low, then most likely we're bearish. The fact that we respected it and now the micro time frame is switching from bearish to bullish as well, we can check this out right here. We have this low, lower, high, low, lower, high, lower, low, and then price action starts moving bullish. So clearly this was enough indication that the micro and macro are both bullish now. What does this tell you? Well, this tells you that now that both time frames are bullish, they're correlating. Price is going to make a run towards the next high, because obviously price is creating higher highs, higher lows. We're trying to catch that major expansion. We're not looking to get in for that small little manipulation. We're catching that major expansion after the retracement is finished. Look at this. This is the expansion. This is the expansion. That's the retracement. We're getting in when the retracement is over. And same exact thing happened right here. Price created a expansion right here, and then it created an expansion right here. what do we have? In this expansion, we have a last institutional down candle before the major move up. Now, this one, there's no institutional candle. If you go down to the 4-hour time frame, you could definitely find one right here, but what are the odds GJ makes a 500 pip pullback when it's used to making about 300 to 400 pip pullbacks, right? So basically what we could do now is we could highlight both of these expansions, one being right over here and then the second one being right over here. Now at this point you could do two things. You could wait for price to come back into this institutional candle that is untested right here, or what you could do is you could take your fib, measure from the low of the expansion up to the high, and look for institutional candles inside the 70, 78, or 88. In this case, let's go down to the daily and let's go to the 8-hour time frame and let's see if we see anything. Nothing on the 8-hour, nothing on the 12-hour. Let's go to the 4H. Let's go to the 3H. Remember, you want to use every single time frame possible. Now the 3H time frame is telling me we have this last institutional down candle here before the major move up. And this is untested as well. It's in my blue zone of interest. So, and it's in the expansion, right? And then if you go down to the 1-hour time frame, everything else is just choppiness. So at this point, I would simply have two areas of interest. One being right over here and the second one being right over here. Why? Well, because these are my two levels of expansion where price pulled up, gave us that break of structure towards the left right over here, or rather continuation of structure. And these levels are untested. And we've seen how institutional candles react off of these levels. And at this point, looking at GJ, whatever it's doing, you can see that the market, what did it leave? Well, it left a ton of liquidity right over here. Liquidity cleared. So we have a ton of liquidity over here. That means that market has a reason. It has a really strong reason for why it needs to come back down over here, because it needs to take out all that money. And if there's money below over here, there's also our institutional candle that price needs to come to mitigate and then go up, right? And someone might say, okay, how do I scalp with this? Well, the scalping video is coming soon. It's going to be on a different lesson. But the general idea is you don't want to be focusing on institutional candles that go against the trend. Now, someone might say, what about this one? You have this last down candle and it's an expansion. Now, technically, this is correct. You could definitely use this as your institutional candle. But the reason I would not recommend you using this as your institutional candle is because, one, there's no liquidity over here. There's none. The liquidity is below. The market is going to have to go below the liquidity, right? Because the market uses liquidity as a magnet. So most likely price will come down to your area of interest, react off of it a little, and then go down to take out all that money that rests below. Now that's basically institutional candles. This was about 37 minutes then. But I'll show you guys a couple more examples. Let's go on Euro USD. Okay, let's just go to a brand new Euro USD chart and I'll show you guys the same example as last time. So let's go to our daily chart. And where was it? Euro USD. Alright, boom. Let's go to our daily chart. Delete everything. Now, daily chart wise, let's mark up our expansion. Expansion, retracement, expansion. So you guys see that, right? We have expansion, retracement, expansion. We're focusing on the expansion. Now, on the expansion, we have this last institutional down candle before the major move up. So price comes into it perfectly, reacts off of it, correct? Now you guys know how we did that. Now, if you guys want to enter with more confirmation, that's a different story. What you want to do is when price does enter your zone of interest, it comes into your area of interest. At this point, this is where structure is everything. You need to analyze structure before you do anything else. So structure-wise, we don't have any confirmation. Everything is still bearish. Micro-wise, it's bearish. Macro-wise, it's bullish. Micro-wise, bearish. But we need micro confirmation in order to take a buy. And right over here, we have that now. Price created a low, lower high, lower low, lower high, lower low. We ended up breaking past this lower high right over here, which is considered as a BOS top. And then we ended up breaking past this lower high right over here as well. These are both breakup structures. Now, if we go down to the 5-minute time frame, what we want to do is we want to find what was the cause of this breakup structure. And the cause of this was this institutional down candle before the major move up. Sorry, that's the wrong wording, my bad. What we want to do is we want to look for the institutional candle that was responsible for that breakup structure. And in this case, we have two. We have one institutional candle being right over here, this really clean candle, and the second one being this really small one. Now, at this point, we found an order block inside of an order block. Because remember, this entire thing is happening inside of a daily time frame OB. And inside of that daily time frame OB, we found another order block, and this is how we enter with more confirmation. Once we've seen that price action is switching from bearish to bullish on the smaller time frames, this is more confirmation telling me that, okay, smaller time frame we're bullish, bigger time frame we're bearish. Sorry, smaller time frame we're bullish, bigger time frame we're bullish as well. Overall structure is buys now. Let's take this buy. And obviously we know what ends up happening. Let's go down to the 15. Let's either 30. Let this run quicker. And let it do its thing. And look at this. Clean liquidity. First of all, clean liquidity right over here. Market ended up creating a ton of clean liquidity right here. Price goes down to take out those lows, taps into that 5-minute institutional candle, and then from there it goes up. Now the only time that I'll ever use an institutional candle, on the lower time frames is when price action is inside of my higher time frame institutional candle. I don't take 15-minute, for example, like if I'm on the 4-hour, I won't be on the 15-minute like saying, okay, I'll sell over here, or I'll take a buy over here, I'll sell over here. I'm always looking for the higher time frame institutional candles, and once I see those higher time frame institutional candles, I have much more confirmation on why price action is going to be using that level as a continuation towards the upside. So I hope that was a good understanding of institutional candles. And one more thing, sometimes you'll see stuff like this happen where go down to the 4-hour, you'll see like an institutional candle right here, right? Well, actually in this case it did play out. Let me find an example where it did not. Alright, right here, you see an institutional candle right here. You're like, okay, this is my major expansion. First of all, you're trading against the trend, so this would not play out, because when you do look for that that sell, look what ends up happening. Price reacts off it a little bit, but then you get stopped out automatically. So that's important on why you should trade with the trend, even if the sell side order block makes sense. For example, we have that move down, we have that break of structure, we have the liquidity resting right over here. It makes sense to take the sell, but at the end of the day, the trend is your friend. If you're going to trade against the trend, things will not go your way, trust me. Now that's initially how I mark up my order blocks. Like I said, order blocks that are deeper in the expansion are much more stronger, and let me show you guys what I mean by that. Go down to like a institutional candle, like right here. All right, perfect. This is a good example. Or right over here, this is a good example. Actually, no, that's not a good example. No. Oh, let's look for a good example live right now. So perfect here. So we have our expansion move up, right? We have this major expansion move up. Now someone might say, okay, look, this is a clean institutional candle. Why don't I take the buy over here? Take the buy, stop loss below, and then it'll go my way. Well, first of all, this is too close to where price is. The market doesn't respect order blocks that are really close to it. It respects order blocks that are deeper. So in this case, take your fib, and like I said, from the low up to the high, you want to take your institutional candles that are in the 70, 78, or 88. In this case, it didn't respect it if you did take the expansion up from here. If your expansion was like this, then it wouldn't have respected it. But if your expansion was like this, and then retracement, which would be purple, and then re-expansion, the market would have perfectly respected this institutional candle right here, right? And I recommend you guys to take it the way I did it right over here, by the first expansion, the second retracement, and then the expansion. So at this case, price ends up reacting off of that last institutional down candle before the major move up. And even sometimes if you do it like this, you're going to see order blocks that look clean, but it won't be in your area of interest or in the blue zone. And that's when you guys have to have discipline. Remember that you got to stick to your rules. Even if it plays out, who cares at the end of the day? We're not worried about that, right? Just remember that we have to stick to our overall rules. Now, there also will be times where it'll look clean, like right here. We have that major expansion up, price break structure, but overall it doesn't respect this institutional candle. And what this generally means is that the higher time frames have a better idea of where they want price to go, right? So for example, right here we showed you that institutional candle that didn't get respected. That means that banks have higher intuition and interest in a different and separate institutional candle. For example, possibly right over here or over here or over here. So thank you guys so much for watching. I hope this video made sense. I'll see you guys in the next video, which would be on imbalances. But other than that, take care, and I hope you guys understood.